The next topic I would discuss about is the state residency optimization, a way to reduce your tax bill. Simply saying, move to states which have no state taxes.
Or lesser taxes.
Or lesser taxes. So, but at the same time, you have to make sure that your domicile, your driver license copy, and you have no nexus to your prior state of residence. In this example, like there are no state taxes like Florida, Texas, Nevada, Tennessee. So if you can move to that state, you can eliminate your state income tax. You will not pay any taxes on your capital gains. And also for estate taxes, like New Jersey has estate tax, few states does not have any estate taxes too. Along with that, there are some business-friendly states too, where you do not need to file any franchise taxes, or they also give strong asset protection. These features are both useful for individuals and businesses at the same time.
But it works out when you have passive income. If you have nexus, let's say if you're an accountant and you have to do the presentation every Wednesday, then it's not a concern. But if you wrote a book and now you're collecting the royalty income, it's a beautiful thing. The idea in a nutshell behind the captive insurance is, captive means captive to certain, not public. Opposite of public is captive, meaning limited to certain people. The idea is you create your own insurance company to pay the insurance premiums to this company. Claim it as an expense over here in your regular business. After a couple of years, you dissolve this company, the insurance company that you created, and take all the money. When you take the money out from this insurance company, you pay long-term capital gain tax. The maximum capital gain tax rate is 20%. When you're claiming the expense deduction, you're saving 37%. So in theory, you're creating a tax arbitrage where regular income is converted into long-term capital gain and save 17% taxes. Now, system is smart. Captive insurance has been in top 3 dirty dozen. The system is smart. So they said you cannot buy from your own company the insurance that's publicly available. Meaning, how much do I want to pay? $500,000 insurance, because I want to move most of the money. So there is a limit. The max you can do is $2.2 million a year. But if I'm buying general liability insurance and I'm paying $500,000, you can buy the general liability insurance for $5,000. Why would you pay $500,000? That's not fair. So the tool is generally used for the insurance that's not easily available in the market. Take an example. When I sit in the tax season, I'm sitting 14 hours. I gain weight. When I gain weight, I get cranky. When I get cranky, I lose business because I'm not talking nicely. So I want the insurance for against gaining weight so I don't lose client. Now, which insurance company is offering the insurance for me not gaining weight? I have a company, Sai Insurance Company, is willing to do it. Okay, how much is the premium, Mr. Kumar? $500,000. So you create a need, insurance need that's not generally covered, where shopping cannot be done. Move large premium, maximum is 2.2, to your own insurance company, keep it there for a couple of years, make it estimate. And since the concept was so expensive to implement, people came with micro captive, meaning you need a captive, you need a captive, you need a captive, you need a captive, let's come together. In order to set up the insurance company, you need certain approval from the Department of Consumer Affairs, and a lot of other approvals are needed. The cost to set it up is $60,000. So if the maximum saving is 17% here, right? So if you are putting $400,000 as an insurance expense, there is no saving. On $400,000, you are saving $68,000. The setup takes $65,000. So you have to be investing a lot of money. But I don't have a lot of money. The only money I want to put is $200,000. Let's find 10 people there. That's the concept against the micro captive insurance. But again, you have to be extremely careful how we use it. In PPLI, I want to summarize it for you quickly. The way you want to do it, you have an overfunded life insurance. So you created life insurance, whole life insurance type of idea, universal life insurance. You overfund it, put extra premium. Now all that money, when it comes to it, is not part of your estate. Death benefit, tax-free, not part of the state. But AJ, if I put all my money in my insurance plan, how would I survive? How would I live? I mean, I make $100,000 and you want me to put $100,000 into this plan. You take loan against the cash value. Now, how much tax do you pay on the loan? 0. Taking loan is not a taxable transaction, right? What happened? Oh, but don't I have to pay this loan sooner or later? That's the best part. You took the insurance for $10 million. You kept taking $500,000 for 15 years. Now you owe $7.5 million. When you passed away to the next generation, your death benefit is $10 million. We'll only give you 2.5 because 7.5 is what you used up in the loan. So in theory, now forget about this concept for a second. Relate this example. You will see a lot of article that this guy, the Tesla guy, Elon Musk, is making $1 trillion in 10 years, but he pays zero taxes. Check how much salary he has last year. You will fight in your company, say, AHA, my W2 is 100. Can you make it 120? His W2 is zero. So what he does, he gets the stocks in the company, and he's taking loan from the company against the stocks that he owns in the company. Zero. Salary, you have to pay payroll taxes, you have to pay income taxes, federal taxes, state tax, a lot of taxes. You keep taking the loan against the ownership that you have in the company. When I pass away, when I die, this ownership is going to be liquidated and the loan will be settled for the next generation anyway. So there are a lot of ideas like that. This idea, I'm trying to relate to that idea because in theory, the concept at the heart is loans are not taxable income to the individual.